In retirement, you have a lot of control over the income that you take and the income tax that you pay. And if you have a lot of money in an ISA, or if you've maybe sold a rental property or downsized your residential house and you've got a lot of money just in a general investment account, you might not need to pay tax for years, maybe even a whole decade. In this video, I'm going to look at how to properly manage your taxes in retirement. I'm Ian Shadrack, a qualified accountant with over 30 years experience. I help people manage their finances and lower their tax bills. So you've got an order of drawdowns. You can live off general savings and investments accounts first because they're subject to capital gains, dividend tax, tax on interest. Then your ISA, which is subject to inheritance tax, then your pension tax-free cash, and then finally taxable cash from your pension sources, whilst making sure you always utilize your personal allowance. The best way to manage your taxes in retirement is to take the taxable part of your defined contribution pension towards the end of the tax year, so in late March, early April, and you do this after you know what dividends you've received, what interest you've received, what capital gains might have occurred, what you got in terms of state pension or defined benefit pension. You work out all that, you then plug in what you might take as taxable income from your pension source, and then that's the way to work out what your tax bill and what your marginal tax rate might be. So in this example, I've got some side hustle income, 6,000, interest income, 3,500, dividends, 20,000. So total income, 29,500. I do have to pay some dividend tax at 8.75% on some of my dividend income because it exceeds the total allowances that I've got. But what I could do is take an extra £6,570 from taxable pension sources. I'm now utilising my full personal allowance. I'm still not paying any income tax, though I do now pay some more dividend tax, but it was only at the marginal rate of 8.75%. So I've done quite well in terms of taking money from my taxable pension, but actually not paying that much money in total taxes. So now I've got an example where someone's got the full state pension and they want to utilize the 20% tax band with their pension income and their interest income. So they add all that up. Here they're utilizing the full amount they've got available to them. They've also got some dividend income that's being taxed at 33.75% rather than the 40%, so that's not so bad. So here they've tried to push it to the maximum without paying 40% on either pension income or interest income. All the taxes are quite complicated, but hopefully that shows that a spreadsheet can inform you as to what your tax is going to be, give you some full transparency. If you take the pension in March, so towards the end of the tax year, once you know what your other income is going to be, that can help you minimize your tax bill. It's really important to optimize your wealth and your taxes in retirement, and the only way to do that is to put together a proper, robust plan. And the best way to do that is through a retirement calculator spreadsheet like the one that I have on my website, and I'll put a link in the description. If you want to get a hold of the income tax calculator spreadsheet, just go to my website. I'll put a link in the description.